Hello everyone, welcome back to another video. My name is Farhan and in today's video you will learn to prepare the accumulated depreciation account. So the question is on the left hand side of your screen and on the right hand side you'll see the workings which I'll go through and explain step by step. So what I need you to do now is focus and follow through the entire content for an excellent understanding. So let's begin. Ashton supplied the following information for the year ended 30 September 2015. So at 30 September 2015, we are given the motor vehicles at cost of $240,000 and we are given the accumulated depreciation of motor vehicles of $45,600. Now, both of these balances, which are at 30 September 2015, can be the opening balances on 1 October 2015, which is basically the new financial year. The depreciation method is the reducing balance method, and the rate of depreciation, as you can see, is 20%. We are given some additional information. During the year ended 30 September 2016, the following transactions took place. So in the first transaction, on 31 August 2016, Ashton sold a van to Cars and Such on credit for $8,000. She had purchased the van on 1 October 2013 at a cost of $25,000. So this is referring to the original cost of the van which we had sold on 31 August 2016. The second transaction refers to the purchase of a new van on 1 September 2016. And this new van was purchased for the business using the personal funds of Ashton. The cost of the van is $19,000 and she was also charged $1,500 for import tax and $200 for the first tank of diesel. The company's depreciation policy is to charge a full year's depreciation in the year of purchase and no depreciation in the year of sale. As you can see, the requirement of the question is to prepare the accumulated depreciation of motor vehicles account for the year ended 30 September 2016. So basically, whatever happened from 1 October 2015 until 30 September 2016, any purchase or any sale of non-current assets, everything has to be accounted for when we prepare the accumulated depreciation account. So let's see how we are going to solve this question. So we understand we are working with a business where the most recent financial year just started on 1 October 2015. And we know this is the case because the balances that were given at the beginning of the question were for the year ended 30 September 2015. And therefore, based on this case, the financial year should end on 30 September 2016. All right. So we need to do some calculations, and after we can do the calculations, we can prepare the accumulated depreciation account. So what we want to do first is calculate the depreciation for the van which we have sold. All right. And let's see what's going on. We know based on transaction number 1, this van was purchased on 1 October 2013. 1 October 2013, which you can see I'm just about to highlight in green. All right, so on 31 August 2016, Ashton sold a van on credit for $8,000. She had purchased the van on 1 October 2013 at a cost of $25,000. All right, so the year 1 for usage of this asset will be from 1 October 2013 until 30 September 2014, okay? And based on the company's policy, in the first year, we are to apply a full depreciation. When you are using the reducing balance method, in the first year of usage, you always multiply the given rate with the cost. The given rate in the question is 20%, as you can see, I'm highlighting in red, and this 20% is multiplied with the original cost of $25,000, which we had sourced from the first transaction, okay? And the full depreciation, therefore, is $5,000 in year 1 for the specific asset, okay? Always remember to calculate the net book value under the reducing balance method. So the net book value at the end of year one, which is at 30 September 2014, is the difference between the cost and the total depreciation we had at that point in time. The cost is $25,000, and the only depreciation we had in year one was the $5,000 which we had calculated, which gives us a net book value of $20,000. Okay? Now, in year two, which would start on 1 October 2014 and end on 30 September 2015, we can calculate the depreciation using the reducing balance method by multiplying the given percentage with the net book value. The given percentage is 20, and the net book value is $20,000, which we have calculated for year one, right? So when 20% is multiplied by $20,000, the depreciation is $4,000 for year two. Therefore, if we want to calculate the net book value now at the end of year two, which is at 30 September 2015, it's the net book value that we had at end of year one, which was 20,000, minus the depreciation that we have calculated again for year two, which was 4,000, and that would give us 16,000. Okay? All right. Now, year three for this van would start on 1 October 2015 and end on 30 September 2016. Actually, not 30 September 2016. It would be 31 August 2016, because that was the day when we sold this asset, right? On 31 August 2016. And we understand there is no depreciation charged in the year of sale. That's the company requirements. So therefore, in our calculations for year three, which would start on 1 October 2015 and end on 31 August 2016, we're not calculating any depreciation, okay? Now, what we need to understand now is the total accumulated depreciation for this van, which we had sold in year three. The accumulated depreciation, therefore, for this van is basically $5,000, which we calculated for year one, plus $4,000, which we calculated for year two. In year three, we have no depreciation, so there's nothing to add for year three. And therefore, altogether, the accumulated depreciation is $9,000 for this van, which we had sold. Okay? Now let's look into the accumulated depreciation account. Okay. So here we have the accumulated depreciation account, and you can see I've already prepared the account in 5-column format. Now, you can see I've started with 1 October 2015, opening balance of 45,600, which is on the credit column. And the reason this is on the credit column is because accumulated depreciation is a contra asset account, and contra asset basically means an account which records the reduction for a relevant non-current asset account, which is the motor vehicles account. Now, all assets by default should have an opening debit balance, but contra asset, because it records the reduction for assets, it should always have a credit opening balance. And this $45,600 credit balance was sourced from what we had been provided at the beginning of the question. You can see accumulated depreciation of 45,600 at 30 September 2015, which gets carried forward as the opening balance on 1 October 2015. Okay? All right, so let's scroll down. Okay, so 1 October 2015, balance brought down 45,600 credit. Then, the calculations that we had done with regards to the sale of the non-current asset, we have established an accumulated depreciation of $9,000, which is the total depreciation for this van right before we have sold, right? Now, if we are selling this asset does not belong in the books anymore. Therefore, within the accumulated depreciation account, we have to remove this asset. We have to remove the accumulated depreciation for this asset from the total accumulated depreciation account, which has the record for all assets, right? Therefore, on 31 August 2016, which is the day of the sale, we are removing $9,000, which is the total depreciation for this specific asset, with the cross-reference being sale of non-current asset. And because we're removing it, this is on the debit column. Because as we have discussed earlier, accumulated depreciation is a contra asset account, which has a credit opening balance, which means when accumulated depreciation goes up, it is always credit, and when it goes down, it's always debited. Because we are getting rid of this asset which we had sold, and because we have to remove this from the books, we have to debit it within the accumulated depreciation to reflect that removal. Okay, so when this $9,000 is removed from $45,600 credit, we're left with $36,600 in credit, okay, as the net balance. Now let's look into other calculations that we may have, and then we will come back to this accumulated depreciation account. All right. Now, I want you to calculate the depreciation of the existing old van. Okay, so what do I mean by that? Now, what's the net book value at 30 September 2015 based on all the numbers that we're given at the beginning of the question? At the beginning of the question, you can see that we were given the motor vehicles that cost up to $40,000 and the accumulated depreciation of $45,600. If we want to find the net book value at any given point in time, it's simply the difference between the cost and the accumulated depreciation, right? Now the cost is $240,000 and the accumulated depreciation is $45,600, which gives us a net book value of $194,400 at 30 September 2015. Okay, now what we're going to do, the asset which we had sold, okay, we will remove the net book value of that asset from this $194,400. Okay, first, so we are removing the net book value of the van which we had sold. So $194,400 minus $16,000, which is the net book value of the asset which we had sold. How do we know it's $16,000? Let's scroll back up. You will see the net book value at year 2 was $16,000, which we had calculated, right? I'm just highlighting in yellow, you can see it, and I'm also putting a tick next to it. Then once we remove this $16,000 from $194,400, the remaining net book value as $178,400, okay? Now this $178,400, which is the remaining net book value, refers to the net book value of the existing old van, okay? So if we have to depreciate now using the reducing balance method, we just simply multiply the given percentage of 20 with this net book value for the existing old van. So 20% multiplied by $178,400 gives a depreciation of $35,680 for existing old van. Did you get it? I believe so. All right. Okay. Now, we also purchased a new van, okay, which is transaction number 2. And based on the company policy, any asset that we purchase in the year of purchase, we must apply a full depreciation, okay? Now, the full depreciation is basically the percentage multiplied with the total cost. Now, what is the total cost? As you can see, we are given so many numbers here for transaction 2. The cost of the van is $90,000, and she was also charged $1,500 for import tax and $200 for the first tank of diesel, right? So what's the total cost of this van? It is $19,000 plus $1,500, which is $20,500, okay? So what's the basis of adding these two numbers? Always remember, the total cost of an asset is the purchase price, which is the $90,000 which we had paid, plus any additional costs that we need to pay to get the asset ready for its intended use. The import tax is a tax that you have to pay for legal purposes. If you want to drive the car on the roads, then you have to pay this import tax, okay? And therefore, this $1,500 import tax becomes part of the original cost, okay? But what about the first tank of diesel? The first tank of diesel is basically the running costs for this vehicle. This isn't adding any value to the vehicle itself, right? So therefore, the total cost of this asset is the purchase price of $19,000 plus $1,500 of import tax, which basically gets this vehicle ready for use to be driven on the roads. Altogether, it is $20,500. Okay, we do not include the tank of diesel, $200, because it's basically the running costs for this vehicle, and which is not adding any value to this asset. So after establishing that $20,500 is the cost, we multiply the percentage of 20 with this 20,500, which gives us a full depreciation of $4,100 for this new van. Okay, now what's the total depreciation from 1 October 2015 until 30 September 2016, which is the most recent financial year that we're talking about? The total depreciation is $35,680, which comes from the existing old van, right? Plus an additional 4,100, which is the number for the new van, right? Altogether, it gives us $39,780. Now, why did we do this? So you will see it very soon. So you will see at 30 September 2016, our accumulated depreciation is increasing by $39,780. And when it increases, we credit it. The cross-reference being the depreciation of motor vehicles. So that gives us altogether 76,380 credit as the final balance. And how do we get 76,380 credit? We add 36,600 credit from the previous line, plus add an additional 39,780 from 30 September, which gives us 76,380 credit. Okay? Then on 1 October, this gets carried forward as the opening balance, which is 76,380 credit. Okay?